Okay, everyone, good to have you in class today. My name is Chinedu. This is E Plus Academic Resource Center, where we take online tutorials for undergraduate and senior secondary students. Okay, so today we're going to be looking at financial accounting, and we're going to be looking at this topic quickly: journal proper, trial balance, cash discount, and the trade discount. Okay, just like I mentioned in the early class, we're about to go into practicals, but there are fundamentals we need to know concerning financial accounting. Okay, and these are part of them. Okay, so journal proper. What is journal proper? Journal proper is used to record transactions for which other subsidiary books cannot accommodate. Remember the subsidiary books, I gave you 6 of them. The cash book, the purchase day book, the sales day book, the return inwards book, the returns inward book, the returns outward book, and the general journal. Okay, so all those books, transactions which cannot be entered into those subsidiary books, they are entered or they are passed through the journal proper. Okay. All right, and what are these entries? What are these transactions that other books cannot accommodate but can go into the journal proper? Number one of it is purchase or sale of non-current assets. Non-current assets on credit. Okay? On credit. Non-current asset here is same thing as fixed assets. Okay? Non-current asset here is same thing as fixed assets. Same thing as fixed assets. Okay? Yeah, on credit. Purchase or sale of non-current assets on credit. For example, ABC Limited. ABC Limited sold. Now, before I proceed, the journal proper, there are 2 fundamental things you need to know. Okay, there are 2 fundamental things you need to know about journal proper. Now, before you pass an entry into the journal, you must first of all identify the 2 accounts involved. Okay, first you must identify the 2 accounts involved. Okay, remember the first video we did when we were trying to introduce financial accounting, we divided accounts into several categories. Okay, now go back to that video, check them, go through it. You'll see where we subdivided accounts into various categories. So now when you identify the 2 accounts involved, secondly, after doing that, you now determine which one to debit and which one to credit. You debit the account that is receiving, credit the account that is giving. Okay? Now, the journal proper, sorry, let me clean this. The journal proper takes this format. We have the particulars. We have the debits and the credits. Okay? Now, the debits, the account that is being debited comes first, while the one that is credited comes second. Do you understand? The account that is supposed to be debited comes first, then the credit comes second. Then, thirdly, your narration must follow. You must narrate the transaction. We're going to do a practical example now, and you will say it. You must narrate the transaction. Okay, let's quickly. So, ABC Limited purchased. ABC Limited purchased motor vehicle on credit. On credit. Motor vehicle is a fixed asset. On credit from Innocent Limited for 10,000 naira on 1st of January 2023. This is a typical example. ABC Limited purchased motor vehicle on credit from Innocent Limited for 10,000 naira on the 1st of January 2023. Now, identify the 2 accounts involved here. Now, we want to know which one to debit, which account to credit. The two accounts involved here are motor vehicle account and the creditor's account, Mr. Innocent. Okay, Innocent account. Okay, so debits the receiver. Motor vehicle is receiver. Motor vehicle is receiving here, while Innocent is what is giving out. Okay, so we have, now let's apply. So we have debit, credit, particulars. Okay, so we have motor vehicle, we have 10,000, then Innocent Limited, we have 10,000. Now the narration will be being purchase of vehicle on credit on 1st of January 2023. Being purchase of vehicle on credit on 1st of January 2023. That should be the narration. Do you understand it? So we debit motor vehicle account and credit Innocent Limited account. Let me quickly show you how we got these entries. So we have debit motor vehicle account. This is credit, debit. So we have Innocent here, which is 10,000, 10K. Then Innocent here, Innocent account. We have motor vehicle, 10K. This is how the entries will appear in the ledger. Motor vehicle account, Innocent is 10K. Motor vehicle account is debited, excuse me, with 10,000 naira. While Innocent account is credited with 10,000 naira motor vehicle. This is in the books of the buyer. That's the debtor now. That's ABC. In the books of ABC. Now, in the books of Innocent, the reverse will be the case. The reverse will be the case. Motor vehicle will be credited with 10,000 naira. Then ABC will be debited with 10,000 naira. Do you understand? This what we just treated now is in the books of ABC Limited, not Innocent. When we want to treat in the books of Innocent, the reverse here will be the case. Okay? All right. So, number 2, we have opening entries. Opening entries. Number 3, we have correction of errors. Number 4, we have goods withdrawn by business owner for personal use. Okay, then 5, we have transfer from one account to another. Then number 6, we have any other transaction that cannot be accommodated in other books. Okay, first one we looked at good assets purchased or sold on credit. Number 2, we have opening entries. Number 3, we have correction of errors. Number 4, we have goods withdrawn by the business owner for personal use. Number 5, transfer from one account to the other. Then any other transaction that cannot be accommodated in the books. These are transactions that only the journal proper can accommodate. Do you understand? Okay, opening entries. When we're going to treat single and incomplete records, we're going to treat opening entries. I'll show you how we do that. I don't want to do that now so that you don't get confused, okay? Then correction of errors. We're going to see that in detail when we start treating correction of errors, okay? I don't want to do any example now so that you don't get confused. Then I'm going to show you goods withdrawn by business owner for personal use and then transfer from one account to the other. I'm going to give example for these two. Then others will see it in a subsequent class. Now, for goods withdrawn by business owner for personal use. When we have, let's say, for example, we have business owner, let's say ABC Limited. ABC Limited withdrew goods worth 10,000 naira for personal use. ABC Limited withdrew goods worth 10,000 naira for its personal use. Now, I want you to know something. Goods withdrawn is chargeable on purchases. What do I mean by this? You withdraw, if there is no purchase, there is no withdrawal. Do you understand? There must be a purchase for you to even withdraw. If you didn't buy any goods or anything, how would you withdraw goods? So there must be goods available before you can withdraw. So goods withdrawn, not cash. This is not cash withdrawal for personal use. No, this is goods. Withdrawal of goods for personal use. When business owners withdraw goods for personal use, it is chargeable on purchases. Now, what do I mean by this? Let's say this is purchase account. Purchase account. Then you have maybe you purchase from a creditor. Let's say Uche, Mr. Uche. You purchase some goods. Then sundry goods that have been taken from a purchase day goods. Sundry creditors. It is. Then these goods withdrawn will be chargeable on the total purchase. So you have drawings here. You see now, this value here now is reducing the total value on this debit side. Do you understand? This value is reducing the total value of this debit side. So the two accounts involved here. Purchase account, and drawings account. Okay? And drawings account. So here we credit. Here purchase account is credited, while drawings account is debited with this amount. So let's interpret it in the journal now. So we have. Let's enter it in our journal. So we have this. Debits, credits, particulars. So we have, which one comes first? Drawings account. Drawings account, then purchase account. Remember, we identified the two accounts involved first, then we now decided which one to be debited and which one to be credited. So purchase account, drawings account, we have 10,000 naira. Then purchase account, we have 10,000 naira. Okay, then the narration will be being withdrawal of goods for personal use. Simple narration. Being withdrawal of goods for personal use. This is how we enter it in our journal. Then lastly, we're going to look at transfer from one account to another. Transfer from one account to another. Let's give an illustration here. Let's have Uche, Abu, and Mike. Okay? Now, Mike is the business owner. Debtor 1, debtor 2. Okay? So, Mike is the business owner here. Uche is a customer to Abu. Mike is also a customer to Abu. But Mike was declared bankrupt. He couldn't pay his debts. Okay? So, Mike now informed Uche to help him pay his debt. Now, Uche now informed Abu that, okay, transfer all debts that relates to Mike to his own account. So, Abu now transferred Mike's debt to Uche's account. Do you understand? That's what we mean by transfer of accounts. Do you understand? Okay, let's analyze this. This is what we mean. So the two accounts involved here are Uche's account and Mike's account. In the books of Abu now, this is how Abu will record it in his own books. Abu is the business owner. Okay? So we now have Uche and Mike. Okay? Now, Uche is a debtor, is a current debtor. Okay, to Abu. Now, Mike is also a current debtor to Abu. Okay, now Abu wants to write off Mike's account because the debt will be transferred to Uche. And the amount, let's say for instance, the amount is 5,000 naira. The amount that Mike is owing Abu, the debt of Mike is 5,000 naira. So what Abu will do now, this is in the books of Abu. That's what we're doing like this. Okay, now Abu will now come here and write Uche, because Uche is the one absorbing the debt. Uche, 5K. So close this account. Sorry, here will be 5K because Abu is owing, Mike is owing Abu 5K. Okay, so Abu will record 5K for Uche here. That means this amount is coming to where? To Uche's account, 5K. So this account now has been written off. So Mike's ledger has been closed. Okay, Mike's ledger has been closed. So debit here is Uche and credit here is Mike. Okay, this is how it's the two accounts involved, Uche and Mike. The account to debit is Uche, while the account to credit is Mike. So how do we enter it in our journal? This is how we enter it. This is how we enter it. Okay, we have here credit, debit. Okay, now we have Uche is credit, 5K. Mike is debited, 5K. Okay, so the narration will be being transfer from one account, or you can say being transfer from Mike's account to Uche's account, or being transferred from one account to another is the same thing. Okay, you can either use any of the narration. All right, I don't want the class to be too long, so we're going to stop here for today. In our subsequent class, we're going to look at trial balance and cash discount versus trade discount. All right, thank you for staying to the end of the class. Do not forget to like, share, and invite more people to be part of our class. Do not also forget to subscribe to our channel and hit the notification bell so you get notified each time we upload new lessons. All right, thank you. Bye-bye for now.